If I were to ask someone who had done finance or who perhaps had an MBA what the purpose of markets was, I would probably get a response that went along the lines of, well, they are a mechanism for capital raising and a mechanism for valuation. And my response to that would be, that's bullshit. Because to me, it is my belief that markets exist purely for my enrichment and they serve no other purpose. You might ask why I have a statement like this. And it is designed to help me navigate and negotiate the inevitable swings that occur in trading. And I actually believe that everybody should have some form of mantra or metaphor or mission statement that guides their activities, but more importantly, guides the sort of language that they use to deal with the inevitable losses that occur. And losses are inevitable. Forget what you've seen on YouTube and what you've read on Twitter. Losses are inevitable. It is just the nature of the game. And there is no doubt whatsoever that markets are capable of generating quite remarkable outsized gains. This is a league table which looks at top performing stocks on the ASX for the past 52 weeks. And you can see there's some extraordinary returns built into this table. But the table itself is a little bit deceptive in that it assumes a linearity in investor responses. It assumes that you bought at the low for the 52-week period and are still holding this particular stock at now. My guess is you would be hard-pressed to find someone who had held Wildcat for a 2,536% return. But just as markets have the capacity for wealth creation, they have the capacity for wealth destruction. And this is the flip side of that league table. These are stocks that have suffered tremendous drawdowns over the past 52 weeks. And as I said, there is an assumption of linearity in the returns that these sorts of tables present to people. This is the reality. This is Wildcat. You can see September was a very poor month. There was a further breakout in the last week of October. This is not a clean chart by any stretch of the imagination. It does not start bottom left of the screen and head in a very, very smooth manner to the top right. There are all sorts of discontinuities, bumps, lumps, little trips in stock price. And so it's very, very hard to generate that sort of return that these tables present. But what is interesting is that there is an asymmetry in this. Because I can guarantee you there are people who bought Lake at $1.10 who are still holding it now and who have suffered the full extent of the drawdown. This is a function of the way people view markets, but it's also a function of their own behaviour and the things they say to themselves. To give you an example of how this works, this is Lake with $10,000 invested. If you had bought Lake when it initially broke out and were holding it as it hit its peak, your $10,000 would have grown to $340,278. Quite a remarkable return. If we look at the flip side of that, that $10,000 is now worth $14,000. You have given back, let's call it around $326,000 in open profit. And there will be people who have done that. There will have been people who bought Lake as it passed its high of $2.50 and who are still holding it at 15 cents. But that's not the greatest example of wealth destruction that I've come across. The greatest comes across from my past, and it comes from a trading colleague of mine who was involved in a penny dreadful as it was getting started, and he made a concentration bet, and he didn't make it out of any form of firm risk management. Concentration bets are not uncommon among very sophisticated investors. This particular individual was not. He just had a punt. At its peak, his equity had a value of over $7 million. And as the stock began to turn and tank, he refused to sell. And the inevitable happened. It went back to his entry point, and the $7 million he had in open profit had simply evaporated. But as it was going down, he was comforting himself with things he'd been told by the directors. He had been told that it was a good stock. It had to be a good stock because you owned it and you're not stupid enough to buy a bad stock. The market doesn't respect our opinions as to what we think is a good stock and what is not. And in terms of staggering statistics, at any given time, around about 16% of stocks in the ASX 300 are actually profitable and paying a dividend, which would be the traditional financial definition of a profitable company. The vast majority of stocks ever listed on the ASX have simply disappeared without ever making a profit. The ASX itself is a graveyard of speculative punts and has been ever since our various regional exchanges were established. But there is a wider point here that is encapsulated by this particular piece of research, which did tend to put the cat among the pigeons. In simple terms, what this research found was that 96% of all listed companies never outperform what we could loosely call the cash rate of return, and that the majority of returns for traders come from a tiny handful of companies. What this means and what this implies for us is that trade management is absolutely everything. That if we assume that the market is going to throw up stocks like Wildcat, by the same token, on the flip side, it is going to throw up stocks like Lake, which having made an outsized gain initially, then collapse. And we have to, in some way, shape or form, manage that so that this is not our fate. So trade management becomes everything to us. And it becomes everything because, as I mentioned, the asymmetry of the psychology we use to trade. It is difficult for us to hold winners. It is very easy for people to hold losers. And you would not think that that asymmetry is real, but it is demonstrated time and time again. And let me offer a very, very simple lesson in trade management. This is Lake Resources, which I've converted to a weekly chart. I find weekly charts for wealth creation are much more sensible than daily charts. Daily charts are simply noise, and they keep people entertained, but they don't offer the opportunity to participate or partake in extended runs that generate these sorts of gains. And you can see that Lake has distinct phases, and I've marked those phases by the blue line. These are simply breakouts of consolidation. It is by and large the simplest trading system you could ever possibly generate. The red line is a continuously plotted ATR line. It is effectively a continuous stop. And the rules are simple. You buy on a breakout of the congestion, you sell on a breakthrough of the stop. And at the same time, you learn how to interpret what you're being told, because the purest tool you can actually ever use and actually ever come across is price. And there is an abject refusal of people to believe this, because everybody plasters the chart with nonsense in an attempt that the nonsense will tell them something special. But when I look at Lake, as I did when it was in its heyday, a mere 2 years ago, I saw a stock that congested and then broke out, congested, then broke out, congested, then broke out, and then had a massive reversal week, which is telling you a story. Everything tells you a story. And that's the generosity of markets. They tell you stories, and they will tell you everything you need to know. You just need to learn to listen. But there is an underpinning to that is immensely important, in that you must live to play another day. And this brings me back to my trading colleague. He never played again. This was a life-shattering event. His life pivoted on this moment. And his life pivoted on that moment because he had failed to obey a very, very simple rule. He did not want to live to play another day, and trade management was an irrelevancy.